A questo punto inizia la trasmissione. Tutti i partecipanti sono in grado solo di ascoltare.
A very warm welcome to all participants to this webinar. As you remember, in July, we launched the idea of a cluster of activities dedicated to grids. You saw also in our movie that grids are always there. So in addition to Grids4Africa, we have a new logo, Grids4Africa, which wants to show the importance that we have to give to this issue. Today, we are going to present the first deliverables of our action, which is the private sector participation in African grid development, which we developed together with the PwC, and we will be available to all of you just after the meeting. But to introduce the context, I have the pleasure to have with us today Antonello Camisecra. He was the past president of Grids4Africa, and now is heading the global infrastructure and network division of Enel. So he will be also certainly one of the main stakeholders to address the program formation. So the issue today is to launch the idea. First of all, I want to thank this wonderful dream team I have in front of me, all the speakers, and therefore at the end, Amel from Schneider will also recapture the idea of setting up a program. We need a program which will be a 2-year program where most of you will be asked to join to give their contribution. So with any further delay, I give the floor to Antonello Camisecra, who will, as my past president, will just set the context why we are there and why we were so smart in doing this idea. Antonello, the floor is yours. Thank you.
Can you hear me well? Okay, good morning, Roberto, and to all the participants to this event. I am very happy to be here today. Unfortunately, I am physically constrained in my room for COVID reasons, but I could not, let's say, skip the opportunity to address some words on this study. First of all, let me make just a very quick step back. While working with Grids4Africa with the main purpose of let's say understanding what were the barriers, the hurdles, and of course working to try to remove them on the developments of the faster, wider developments of renewables as main mean through which give access to electricity to a larger, possibly larger share of population in Africa. We have identified that we were focusing on a very important part of the issue, which is the lack of generation, the lack of affordable, sustainable generation. But then analyzing the entire value chain hurdles, we have identified another additional one of the same magnitude, probably even more, let's say, blocking than the lack of clean and affordable generation. It is the fragility of the network infrastructure. Without a reliable, widespread, well-managed grid, there will be no access to electricity whatsoever, especially in the urban and peri-urban areas where most of the population is living today and is projected to be living in the next 2 decades, reaching a level of urbanization that is well above 70%. Is exactly there where we have to bring power to avoid the very, let's say, dramatic fine line between neighborhood with prosperity and possibilities of a modern life and areas of desperation, which in many major metropolitan areas of Africa are divided by, as I said, just a fine line. So among the many things we have analyzed, I think this study is absolutely astonishing in the quality and in the clarity of the outcome. Among the many barriers, we have identified one that is possibly difficult to cope with, but simple to understand and address, which is a simple fact that in the grid sector, in the network distribution part of the value chain, for historical and logical reasons, for understandable reasons, there is an absolute lack of private capital participation. Now, if you look, and this, of course, it's let's say making the journey of the state-owned, or let's say the local grid operators much more difficult, because they are typically fragile, not well managed, with financial stress. So with an implicit inability to keep the pace of electrification, bringing the infrastructure closer to the demand, even in situation of very low income, very low spending power, where the tariff efficiency is the priority #1. So I have to say that it is quite evident from the journey that has been lived by other economical areas, say Europe many years ago, but then Latin America most recently, when the electricity sector has been able to attract private capital in the distribution part of the value chain. The results in terms of quality of service, electrification rate, reinforcement of the grid, efficiency on the tariff side have been absolutely evident, absolutely positive for the final final tariff payers, and improving a lot, not only the let's say economical results of this distribution company per se, but most importantly, improving a lot the quality of the service and the capability to enlarge the customer base, which is what I think is the priority #1 for Africa in the next 2 decades. So I think that if from one side we have to continue to push very hard for renewables to become the sole source of electricity for the emerging consumptions of Africa as a whole. On the other side, we have to keep, let's say, augmenting visibly the effort in convincing regulators, policymakers, and the same distribution companies that they absolutely need a stronger cooperation with the private capital, with the private sector, in order to enhance the quality and the performances of the existing distribution grids, also with the target of expanding them, reaching territories where today there is no light. And with these words, I want to thank PwC and Grids4Africa for this study and welcoming the launch of the Grids4Africa, let's say, chapter within Grids4Africa, because as I said, I believe in the next 10 years, the understanding of the grid issues will be key in order to also to deliver the main purpose of the Grids4Africa Foundation, which is bring clean, sustainable power to every citizen of Africa. Thank you very much, Roberto, and have a very fruitful discussion today.
Thank you so much, Antonello, and thank you for being the first to attract the attention to this topic. You should be very happy that we are proceeding according to your initial push. Grazie molte. And now I have the pleasure to introduce quickly the moderator of the session, Anna Rosal. Anna has been with us 3 years in the foundation. Then she moved to the IAEA, where she was in the Africa desk. And now, luckily for us, she's back to us. And today is the first time she has the pleasure and the honor to moderate this wonderful session. Anna, the floor is yours. And thanks for being here. And good luck for the meeting.
Thank you very much, Roberto. Thank you very much, Antonio, for the opening remarks and for those kind words. A very good morning from Rome to our distinguished audience here today, to our Grids4Africa partners, members, and so many stakeholders logging in from across the world, across Africa, indeed, we hope, for this specific event. It was mentioned this is the second event of the Grids4Africa initiative after launching back in July. And the reason why we're here today has been mentioned. Grids are the bedrock of today and tomorrow's electricity systems. They're absolutely crucial for Africa's clean energy transition, and that is what Grids4Africa aims to do, to really raise awareness about this fact, about the challenges encountered, and support the development of public-private sector partnerships to really have the grid sector take off across Africa. In July, we launched the initiative. Today, we're going more in depth. We're going more looking at public sector participation in the African grid sector with the launch of the first study that will be presented in just a few moments, and by gathering a discussion of experts who have been in this field in Africa, very active for many years, and will share some of their very interesting insights with us today. So without further ado, we'd like to start the agenda and move towards our first speaker, who does represent a very important angle when it comes to this discussion, the angle of the development finance institutions, who play a very catalytical and leveraging role when it comes to generation and grid infrastructure investment, of course. Ms. Linda Munyengeterwa, who's the Regional Industry Director of Infrastructure for Middle East and Africa at the IFC, the International Finance Corporation, has vast experience in this field. It'll be very interesting to hear her experience and the perspective of the IFC when it comes to boosting the grid sector in Africa. Linda, please, the floor is yours.
Thank you so much, and hello everyone. I'm not really sure why my video has decided to not come on. It was on just a second ago, but maybe let me just press on with the presentation, and I can deal with that a little bit later. So thank you very much for the honor to present today. I think it's such an important topic, and I'm really excited that we are talking about PPPs in the grid space, and generally about grids in Africa, because I think there's a lot of work that needs to be done, and it's certainly one area that has been neglected over the years. So, sorry, I think I've figured out how to turn on my camera. There we go. Fantastic. So maybe if we can just go to the next slide. I think the opening remarks by Antonio are actually spot on. From an African perspective, we have been talking so much now about the energy transition and renewable energy, and I think in the process we have really not focused on what's happening on the grid space. And I think, whilst there are rising opportunities for distributed generation, for mini grids, for isolated grids, there is still need for your traditional grids, and really certainly a need to make sure that they continue to function. Otherwise, the integration of renewable energy in most instances will really be challenged. So let me start with some statistics just to sort of ground the discussion. You'll note that over 600 million people in sub-Saharan Africa have no access to electricity. Over $4 billion of investment is required per annum in transmission in order to actually reach the access agenda. And another interesting statistic that I came across was that the transmission infrastructure in Africa is of the same amount as that of Brazil, which is actually quite staggering, because then it actually gives you a sense of how huge the gap is. So, so basically, I think what we've realized is that transmission and distribution networks are very limited across the continent. There's a huge energy access gap. There's significant investment required. A lot of the transmission, a lot of the grid works, whether you're talking about distribution or you're talking about transmission, has all been handled through the public sector. And we all know that you know, the pandemic has really stressed the fiscal space, and most governments are actually moving a lot of their funding away from, you know, your general infrastructure, including energy, into the social infrastructure, into social safety nets, and really trying to help the citizens. So it means that, you know, if we don't mobilize other sources of funding for energy in Africa, we are going to see this this divide grow even more pronounced. So I think the models that we've seen in other regions, such as Latin America especially, have been able to really bring private and public together and really catalyze the growth of the sector, which is something that we've not seen in Africa. And so, you know, sort of my concluding in terms of the overview of the Africa sector is that standalone transmission and distribution is certainly something that is not common in Africa, and governments have not yet warmed up to this idea. And I think we'll see that. I think it's only less than 25% of the utilities in Africa actually, you know, adopt PPP models. Next slide, please. So the challenges that are faced, I think it's important to understand why has the T&D space in Africa not evolved at the same pace as the rest of the world, as the rest of the developing world, that is. And I've just highlighted some of the key factors from our perspective that we think are the key contributors. So the first one is a lack of solid regulatory environment. I think if you're not able to set up PPPs, if you're not able to have, you know, proper electricity laws, if you're not able to have proper planning in the sector, it's pretty much impossible to actually attract private sector to set up projects in the country. The other issues that we've seen faced by our utilities are just inefficiencies. So, and they stem from a number of issues. Part of it is a lack of capacity, and by capacity I mean financial capacity and human resources. So you tend to find that a lot of this results in a lot of you know, very extremely high losses. In some cases, we've seen utilities that have losses in excess of 40%. So, you know, you're producing nearly 50% of the energy that you're producing is simply lost. The dependence on government has been a crippling factor. To a large extent, a lot of these utilities are dependent on subsidies. So you'll find that a lot of them are not in cost recovery mode. So and have to depend on government support, which obviously is not always consistently flowing. And so for as long as there's that dependence, I think seeing utilities become profitable on a standalone basis will be extremely difficult. And then finally, the situation has obviously been made worse by COVID. In some cases, I think we've seen, you know, the reduction in energy consumption, which has obviously resulted in reduction in cash flows, which is also, you know, sort of a spiral effect that has continued to plague the utilities. So a whole host of issues that are impacting utilities and their viability on the continent. Next slide, please. So what do we want to do? We've seen, you know, it's a difficult sector. There are so many challenges. You know, we've got governments that are not ready to sort of invite private sector in. But why does it make sense to adopt PSPs in African grids? It really, I think the overarching reason, and it's actually, I realized that I didn't put that as my first point, but it's really capital mobilization. Because if we don't mobilize capital from elsewhere, the grids will not grow. The population is growing at an excessive rate. Urbanization is increasing at a rapid rate. And of course, we're talking about renewable energy, which requires battery, which requires technology. And if we are working with governments that don't have the capacity to implement all of these things, the continent is going to be left behind. So it really is actually quite urgent to get private sector involved in our grids on the continent. So a few other sort of motivating factors are the fact that it's a proven model. PPPs in transmission are well established. It's something that's been done across many countries and successfully at that. So Chile, Brazil, India, Philippines are just some of the countries that have adopted this model successfully. The financial demands, as I explained, are significant, and we're beginning to see a situation where governments are diverging some of their funding from infrastructure into social sectors. So we're going to see the sector really squeezed and really not growing. So private sector mobilization becomes absolutely critical. I think the other key issues is, like I mentioned earlier on, one of the key challenges of grids in Africa is capacity. So you bring in private sector, you immediately start addressing the issues of capacity, you immediately start addressing the issues of international best practice. So your PSPs will bring in management, they will bring in know-how, they will bring in technology. All of these are so critical as we transition to clean energy and we try and modernize and stabilize our grids. So efficiency will also be one of the reasons why PSP makes sense. And of course, increased competition will result in lower costs. I think it's fair to say that right now, it's the cost of electricity in Africa is probably the most expensive across the entire world, and certainly more than 4 times the cost of what you would see in a similar developing market. So really, so why PSPs? I think in summary, I've listed on the right-hand side of my presentation the key drivers, which are really the integration of renewable energy, aging infrastructure, the security of supply and the stability of the networks, interconnection, and obviously modernization of the grids. Thank you. Next slide, please. So the case for PSPs is clear, and but I think we have to be cognizant of the challenges. And as we think about bringing private sector into transmission, into distribution in Africa, what are the key issues that an investor will have to think about? And what are the key issues that we need to address, or that we need to help the government address? The first one is obviously, a key consideration will be what is the country risk in the country that I'm going into? What is the security situation like? Are there expropriation? Is there legal, what is the legal environment looking like? So a whole bunch of issues that one has to consider. Is the population big enough? Does it make sense to actually build out a grid in this country? And how does that play together with distributed generation versus your traditional grids? So a whole bunch of issues that one has to consider before stepping into the PSP world in Africa. But in addition to that, I think the other key considerations will be the enabling framework. So I think one of the key reasons we have not seen a lot of private sector participation in transmission in Africa is simply because the framework has not been there. The governments have not put up the regulation to accommodate private sector participation. The laws are such that it's not easy for private sector participation to come in. The way the electricity sector is structured is such that it's not conducive for private sector to come in. Other issues that we're facing, hurdles that we would need to clear in order to get private sector participation would be availability of funding. Now, we all know that if you're trying to do a transmission line, the studies that are required, whether they're environmental and social or the feasibility, require quite significant funding. Now, I think that as we've seen the markets evolve, the availability of funding is becoming less of an issue because there are many parties that are now interested in supporting the development of the energy sector in Africa. So whilst that has traditionally been a huge issue, I think there are solutions that one can tap into to address that. The creditworthiness of utilities is obviously also been, a significant issue because on your public part of the PSP, you really want to have a counterparty that is creditworthy, that can also put their equivalent share on the table when it comes to investment, when it comes to contribution to the project. And it's fair to say that most of our utilities are not in a very good shape and would struggle to become a credible counterpart. So that's a situation that one has to overcome. The sector viability, the sector planning. I think as I see when we go into markets, the first thing we look at as we try and invest in a project is to try and understand what is happening in the sector. Is it sustainable? What is the tariff regime looking like? What are the laws that govern electricity distribution and so on and so on? What is the planning? Are we, is there visibility in terms of the long-term needs of the sector, and so on? And I think the fact that you find a lot of countries are not able or don't have the capacity to plan, that also creates a situation where, as an investor, you're not able to project long-term in terms of what's going to happen in the sector and how is it going to evolve. And then finally, the biggest issue has obviously been the ENS impact. If you're looking at greenfield transmission, are you displacing people, getting way leaves, getting the land? All of that are significant issues. So not an easy set of issues to deal with, but by no means not insurmountable. I think we've got good examples where the private sector has participated very well in the transmission sector, in the distribution sector, and I'm actually very pleased that you have one of our clients speaking a little bit later on, and who will be able to tell a little bit more about how it's working with the private sector in distribution in Uganda. Next slide, please. So finally, what are the models that we can adopt to bring in private sector into the market? And I'm not going to go through this in detail because I'm sure a lot of people are quite familiar with the different structures. But maybe at a very high level, the easiest and probably more straightforward one is a private transmission company. So you set up a company, you have it run by the private sector, it's capitalized by the private sector, and yeah. The other options actually is the boot, which obviously is one that's is a fairly, I think I've repeated some of my comments, I'm sorry about that, but you can basically have a boot without a long-term contract. So you basically identify your developer and you do your market studies and you figure out how to build and operate and eventually transfer the asset to the government. I'm not going to go into the detail of the boot with the transfer because it's pretty similar to the boot without the long-term agreements. Just the difference being obviously the tenor of the contract. And I can see that my time is up. And then very quickly, obviously, your traditional EPC. EPC, in my view, doesn't really necessarily bring you, all the private sector that you want, because you don't want to just build and move. You want to build and operate to ensure that you bring in the capacity and you support the government and you ensure that the asset remains sustainable and continues to add value. Thank you so much.
Thanks to you, Linda, for this most insightful presentation, because it really does give us a very good overview of many of the challenges that are faced by the African utilities. At the same time, just how pressing grid sector development is, not in the least because of demographic growth and urbanization rates, but also simply because of the need to restructure, to refresh and expand, in fact, the network infrastructure across the continent. And you've given us some very good examples as to making the case for why private sector participation there has worked in other parts of the world, some of which most of our speakers will also give us some very good highlights to. So it is a proven model, and I think that you've proved that, in fact, with these few points. So thank you very much for that. And I would like to maybe segue into our next presentation towards Professor Ignacio Perez-Aliaga, who's a professor at MIT at Comillas University at the Florence School of Regulation, of course. Professor Aliaga has advised governments and companies taught about the power sector regulation for more than 30 years. So we are very eager to hear some of the insights that you have about how to improve and enhance investment within the African grid sector, and how, in fact, regulation can play a key role there. So, Professor Arriaga, the floor is yours.
Thank you very much for the introduction. Good morning from Madrid. I'm really pleased to participate in this event that focuses on the heart of the problem of lack of access and poor supply of electricity in sub-Saharan Africa and also in other parts of the world, which is the lack of investment, and I would also say the lack of attention to the activities of transmission and mostly distribution of electricity. So thank you very much, Roberto, and the colleagues of Grids4Africa for organizing this event and inviting me. So it is quite clear for everybody, and I think that the document that is going to be shared with us today by Grids4Africa will make that evident, that there is lack of investment in African electricity networks and transmission and distribution. And there are a number of documents that will make clear that. I think I have to remove the. Are you seeing my screen well? Yeah, I think it's better.
Yes, we can. Very well.
Okay. The number of documents, for instance, the World Energy Outlook 2021, that shows for transmission and distribution, as you can see there, for emerging markets and developing economies, which is the light part here, that it is needed a huge amount of investment. If we look at other documents, for instance, this one from this very well-known document from the World Bank, you can see that in this century, the amount of investment in distribution has decreased immensely. So you can see the numbers here. And in this document, Energizing Finance, that is produced every year and shows, I'm not going to, don't be scared to present this slide in full, but you can see here how the investment is in this column here, goes to renewables in generation, goes to fossil fuels in generation also, and this is the part that goes to transmission and distribution, which is ridiculously small. And if we look at what happened in the last year, because the preceding one was for 2020, this is for 2021, well, this part for transmission and distribution has grown, but it is only for transmission and not for Africa. So it is clear that we have a problem of investment in transmission in Africa, as Linda has indicated very clearly in her presentation right before me. This is the amount of investment in transmission lines per capita, and this is other sub-Saharan African countries compared with Colombia, Peru, Brazil, Chile, France, United States. So it is very clear the lack of investment in a huge continent as Africa is. But my key message is that if we want to increase investments in Africa grid networks, both transmission and distribution, that would critically depend on two factors: adopted regulatory environment and business models. And following established principles is absolutely of essence, and too much creativity in taking unnecessary risks, developing too innovative approaches, typically for transmission, is not a good idea. So if we start with transmission, reinforcing what Linda was saying before, this document very clearly establishes a business model that has worked in other parts of the world, still has to be adopted in Africa. And the problem is in Africa compounded by flawed regulation, but the model is known and it works. The problems with regulation in transmission in Africa is that sometimes regulation introduces unnecessary risk for investors. And regulation of transmission should be very simple. It's a regulated monopoly. So what we have to do is to ring-fence the annuity that has to be paid with tariffs, which is not a large part of the total cost of electricity, typically something like 10%, and try not to introduce spurious regulation, such as making the remuneration of transmission depending on the volume of flows or wheeling charges. Should be just the cost of service, what is cost in an annuity over the lifetime of the asset. And it is fine to add incentives, but should be incentives related to the business of transmission, which is being available, and not other, like reducing losses, reducing congestions, and other things that belong to the system operator and not to transmission. If we move to transmission at regional level, and we see here the power pools in Africa, I don't have time to talk about that. I teach courses that last weeks on transmission regulation for regional markets. But I would send just the message that we have to follow in the design of regulation for transmission in regional markets, the single system paradigm that, for instance, is successfully applied in Europe. And this is that the outcome of the regulation should be as close as possible to the regulation that we would apply in a single system of regional dimension. What do I mean by this? So this is one of the power pools in Africa, Western Africa power pool. You see all the transmission lines and the borders and the different colors between the countries. Okay, we have to think this way. We have to erase from our minds the borders and design the rules of cost allocation of transmission, the dispatch of generation, the physical flows, everything, thinking of something, a regional market without borders. I move to distribution. So probably this slide will appear several times during this event today. It is a very clear message that the income that is obtained with the tariffs as they are now in the different countries in sub-Saharan Africa, which is this circle, is inadequate, except for a couple of cases, to cover the total cost of operational maintenance in orange or investment in green. So that means that the companies, and typically that all that deficit falls on distribution, are in dire financial conditions. They are not able to recover their costs with the tariffs. And the problem with distribution is that, contrary to transmission, where the business model is clear, we don't know what is the right business model in distribution in developing countries for that still are struggling to get universal access. Why? Because the customer tariffs to begin with are below cost, and the discos don't receive enough funding for their activities. So they don't have a cost-reflective revenue requirement. Because of that, they cannot invest properly, they cannot maintain and operate properly the facility. That means poor quality of service. That means unhappy customers that will not be willing to pay the bills and they will steal the power, and that will increase the deficit of the distribution company with a vicious cycle that the company will not be interested in new connections, and the governments will not dare to increase the tariffs because the service is so poor. And there are other facts that are important, which is rural electrification is expensive. It has been subsidized anywhere in the planet when it was done. And the further you go from the existing grid, the more expensive it is. The rural population in those areas typically have low affordability. And then they have the distribution company with grid extension has to compete without higher level of coordination with off-grid solutions, and which are fine, perfectly fine, but they should be coordinated with the grid extension. So how to approach this? In my group, my research group at MIT and Comillas University, we have produced a number of reports, and you have the reference here, the link to these reports that try to promote an approach that we call the integrated distribution framework, that is based on 4 very basic principles that everybody will accept: that we need to achieve universal access, so nobody left behind; that we have to integrate both on and off-grid solutions; that the business models where billions and billions of investment are needed in distribution should be financially viable, otherwise we will not find those private investors that will put that amount of money; and that all that effort should be focused on development, because it is the ultimate goal of electrification, of course. But if we go one by one to these principles, we will realize that they are very difficult to meet because they have profound implications. For instance, if we talk about universal access, that means that we should leave no one behind. And that means that we need an organization, a utility-like organization, that should be the default provider, should go where nobody wants to go, and should be the last resort provider, should cover the failure, the abandoning of any other company. When they fail, they should replace it. And leaving it to the market will not work, because the market will not provide a default provider or the last resort provider. The second pillar is that we have to integrate, to coordinate on and off-grid solutions. That means that we need an integrated planning that frequently is done in countries of sub-Saharan Africa, sponsored by the World Bank or the African Development Bank, etc. But that has to be followed by rules, by regulation that really integrates these 3 modes of electrification. When the grid arrives, or when the mini grid sometimes arrives to a place with poor quality of service. And that leads to the next pillar, which is we need not only integrated planning telling us where we should have grid extension, mini grids, or standalone systems. We need to pay for it. We have to finance it. The models have to be financially viable. And how to achieve that when the distribution company is a low-hanging loss. So it is for sure that they will be losing money. Well, there is a beautiful instrument, which is the concessions, that has been successful in other parts of the world, like India, in Latin America, sometimes also in sub-Saharan Africa, for instance, the case of Uganda with Umeme. And that model that could make sure that the private investor will find a viable business model, because the concession arrangements could provide for that, should be more thoroughly studied and applied in Africa, in our opinion. And finally, it is important that all this should be done focusing on development. It is not enough to provide a very basic level of electricity for a few lights and a radio or a TV to every household. It is also necessary to provide for productive uses and community uses. Otherwise, the communities will continue being poor forever. We are working in our group, this is a current research that we are doing, trying to develop an index of progress in electricity access. We have the collaboration of some colleagues in Grids4Africa, and this is my final slide. What we try to prove with this new index is what is the lack of sufficiency and adequacy in electricity access. So what we are doing for different countries, we are providing an indicator, an index that is a multidimensional, that will tell us with a percentage which is the current level of financial effort in electrification compared to the one that will be needed to achieve full electrification by 2030, according to the Sustainable Development Goal 7, right? The color of this circle indicates whether the financial, what is the financial viability of that effort? Because in some countries, the effort that has to be done could be financed easily. In some other countries, it's challenging. In other countries, it's impossible. And that message should be clear with the current financial institutions and financial instruments that we have in a large number of countries in sub-Saharan Africa. It is not possible to achieve full electrification by 2030. And the other part of the model, what it tells us is for the 4 pillars of this integrated distribution framework that I was mentioning before, how much the current effort in each country is really achieving that pillar. So
thank you, Professor Arriaga. I'm afraid I have to ask us to.
Thanks.
Well, 5 seconds indeed. Thank you very, very much, Professor Arriaga, for this most comprehensive presentation, which I'd like to add to our audience will be shared online and in the event proceedings. So many of these details that, as I understand from Professor Arriaga, are delved in through weeks and weeks of course material here explained in the short space of 10 minutes. You will have a chance to look at that more in depth. And I think Professor Arriaga highlighted very well just how deep the challenge really is, how small a part of the investment to electricity sector in Africa goes towards transmission and distribution, and how the adopted regulatory environment and business models are absolutely key there, especially focusing on those 4 pillars of access, on and off-grid solutions, and development as well. So thank you very much, Professor Arriaga there, and I would like to go now towards our third speaker at this point, who really does bring us back to the heart of Grids4Africa initiative, which is Yasmina Hodzic, Manager of Climate Change at PwC. Yasmina is one of the lead authors of this first Grids4Africa initiative and study, which looks more in depth at exactly what we're talking about here today. To be clear, this report, as mentioned by Roberto Vigotti, is online on our website and will be shared. But before you rush off to read the report, the floor goes to Yasmina to share the key findings here with us today. Yasmina, the floor is yours.
Thank you, Anna. Thank you everyone for this beautiful organization. Again, my name is Yasmina Hodzic, Manager Climate Change at PwC Italy. I have the pleasure this morning to present you the study itself. It's been prepared as a collaborative effort of PwC and the Grids4Africa Foundation. Can we put the next slide, please? Thank you. Right, so it's been prepared by PwC and the Grids4Africa Foundation. I'd like to think of it as an addition to a long track record of us working together. In the past few years, you may have seen some of our reports on the right side of this slide. Including we've had a flagship survey on investment risks both in the Med area. This year we expanded it to sub-Saharan Africa. We've also prepared a study on cross-border PPAs in Morocco. So all of these are available for download. This particular study that I'm presenting today has been prepared in collaboration with PwC Italy. We're also quite happy to have received input from 4 country offices of PwC. So we really do have some local insights and expertise from Kenya, from South Africa, Morocco, as well as Ghana. I'd also like to thank specifically the Sub-Saharan Africa team of Grids4Africa, led by Antonio Passero. So today I'm the one speaking, but really it has been a team effort. A lot of hands have worked on this report, and I'm really glad to have the chance to tell you about it. Next slide, please. Okay, before I go into the report itself, I wanted to set the stage with a slide on challenges that grids are facing globally. So the overarching challenge for grids is what we at PwC have called performing while transforming. And so what this means is that grids globally need to ensure continuity and security of supply at all times. So this is obviously the priority #1 for grids. At the same time, they also need to transform to adapt to the rapid change in the electricity landscape. And so that rapid change is driven by these 4 phenomena that I have on the slide. They're namely decarbonization, digitalization, demand disruption, decentralization, I'm sure all of you are familiar with these terms. I will not go into detail on actually explaining these phenomena. But the overall message is that globally, grids are facing this challenge of at the same time performing as well as transforming. And there is also obviously a growing need to invest in this transformation. And that is a challenge for both developing and developed countries. And that is even before we enter into the specific problems that the African grids have. So that is something that I want us to keep in mind, that is the challenge for grids overall. Next slide, please. And here we come to Africa, where obviously before we even start to talk about transforming the grids, obviously African grids have a staggering problem of performance or lack of performance. So in this slide, these are directly from the report. Some of them are things that have been already said. We all know it. Over 40% of Africa's population does not have access to electricity. The middle chart shows that even those who do have electricity tend to use very little of it. So what this chart shows is a per capita consumption of electricity. Only one country, so South Africa, is above the global average of consumption. So the global average is about 3 megawatt-hour per capita. Only South Africa is above it. So that is obviously a problem of both affordability as well as an underdeveloped industrial sector. And then the last chart is the one on the left, is the one on the right, sorry, is the figures about SAIDI, or the number of hours, to put in simple terms, the number of hours of sustained interruption for the average customer. So what you see again is that only one country out of the 10 that have been analyzed in this study, so in this case Morocco, only Morocco is doing better than the global median. So every other country is below the global median. Actually, what this chart shows is even probably more optimistic than the real situation on the ground, because of what we usually call the availability bias, meaning that there is not a lot of data, or there's not a lot of reliable data about SAIDI. Those countries and those utilities who do report it are actually usually the countries that are doing comparatively better. And so the data that is missing is actually the data for those utilities or countries that are doing even worse. And so if we had the real and correct numbers on this chart, probably the bars would look even longer. So there would be even longer SAIDI. But so without now entering into problem of data, what is enough to say is that Africa is estimated to lose between 2 and 4% of GDP annually due to low service quality, electricity service quality. And why is that? I mean, the reasons are very simple. When electricity goes off, businesses need to close, refrigerated food goes bad, people have to run backup generators. Those backup generators run on fuel that is also expensive. So obviously the problem goes on. I have not said it before. In this study, we analyzed 10 countries. So those are the 10 countries that are listed in this chart. We deliberately chose countries in a way that all regions are represented and that more or less similar, more or less different circumstances are also captured. So you see it in electricity access rates. We have Algeria and Morocco that have basically full access, and then ranging through some middle ground countries, and then down with Tanzania and Zambia, which have very low electricity access rate. That was not a coincidence. We did it on purpose to capture the very diversity of situations. Next slide, please. Okay, so what are the causes of this problem that we saw, the SAIDI problem and the kind of the overall conundrum? Professor Arriaga as well as Linda have said it already before. Obviously, it is a very complex issue, but in our study, we've tried to capture it in this phenomenon that we call the utility vicious cycle, that is underinvestment and low financial sustainability of utilities. So let's look at this vicious cycle. Basically, let's pretend that we start with utilities underinvesting in grids. Many utilities, if not most in Africa, are in major financial distress. They cannot afford to invest in maintaining or building out new grids. So what they do is they structurally underinvest in both maintaining grids and also obviously in also building out new capacity and new infrastructures. So as a result of this underinvestment, what happens is that service quality is eroded. We start to see growing outages, blackouts, we see brownouts, and also we start to see growing system losses. In the countries that we analyzed, the 10 of them, system losses can be as high as around 30%. And that is the data that is available. So obviously, again, availability bias. Maybe it's worse than 30%. But let's assume that even if it stays at 30%, that means that 1/3 of your electricity that you generate, for one reason or another, you don't invoice it, right? So you obviously have a financial problem. And then continuing in the vicious cycle, once the system gets so bad, customers stop paying for electricity. Non-payment is in fact quite an acute phenomenon. Many of you will have known this. Some in academia, often it's called the culture of non-payment. So there is quite an acute problem, especially in some countries, for example, South Africa. Customers don't perceive that the service is good enough for them to even pay for it. And then oftentimes another thing that happens is that customers opt for their own independent generation, or they look for alternative. So basically, as the service quality erodes, the utility starts to receive even less and less money. They have an even smaller customer base. That means that they collect even less money. And so going on in the vicious cycle, as a result of this financial shortfall, the utility has even less cash to invest. So that is quite clear. Basically, we have a clearly unsustainable situation in here. And then the fundamental problem is that utilities tend to run a business model which is financially unsustainable. Professor Arriaga has elaborated it in very clear terms. Tariffs are simply set at levels that do not allow for the recovery of the full cost. A lot has been written about this solution, about this problem. There are no easy solutions. But what is certain is that without cost-reflective tariffs, the room for private sector participation is extremely limited. Right, so it's very hard for private operators to enter if the utilities are getting structurally subsidized and there's a structural unsustainable business model. So that is a key barrier that actually Linda mentioned earlier, the barrier to entry. Next slide, please. Okay, thank you. So what is the solution to this vicious cycle? In our study, we argue that a mix of private sector participation and regulatory reform can go a long way in breaking up the vicious cycle in two distinct ways. So the first one, breaking up vertical integration. This can serve to create separate, self-standing market segments in which market competition becomes possible. So what happens often currently is cross-subsidization, where let's say that you have one part of the sector that is performing quite well, and then another part is performing poorly. The well-operating ones cross-subsidizes the other, and the end result is suboptimal for both segments. In some countries that we analyze, there is even a common utility model between water management and electricity. So obviously that inhibits the creation of self-standing markets. So also business opportunities are not clear when you have vertical integration. So creating separate entities obviously creates room for competition within individual and self-standing market segment. The second element that can go a long way is opening the grids to private sector participation. What that can do is it can provide an impetus to competition. Competition, Linda has said this before, competition also means lower costs, which is obviously an acute need. Competition also attracts private financing, or simply private sector participation also attracts private financing, and that is acutely needed. And also private sector participation can lead to the creation of new business models, and business models that can be sustainable and that can resolve some of the conundrums that we've seen before. Speaking of our study in particular, when it comes to private sector participation, we explore in our study different models, different forms, which we illustrate here in this chart. They are different in the extent of private involvement. So you see that the arrow goes from left to right, where service contracts have kind of the lowest private sector participation, and then it goes to management contracts, various forms of concession up until merchant projects. So there are different models, different PPP frameworks in which risk is shared differently. There's also different time frames, but fundamentally in our study, we don't recommend any one model in particular. We wanted to leave it there and with the idea that every country will have different needs, and even within one country, different segments may have different needs. But certainly this is something that exists and that has been experimented in South America, for example. So in our study, we leave it kind of open. We do go in the pros and cons of different models without explicitly recommending one way or another for every country. Next slide, please. Okay, so here in the next two slides, I have small snippets of the research that has gone into the study in particular. Obviously, you can download it later on, so you can look into it in more detail. These are really just small bites of what we have in there. So here we have 10 countries. It's kind of a complex visual, but hopefully intuitive on how electricity markets are organized. Vertical axis shows the extent of reform, so you have either vertically integrated or unbundled markets. Horizontal axis shows the extent to which private sector participation is allowed, so first starts with generation, then transmission, then distribution. And then the color of the icon illustrates whether it's private or public. So yellow means publicly owned, and the red means that it's privately owned operator. And so what you see, basically the conclusions, is that most countries have at least some degree of private sector participation, generally in generation. This is where it's most frequently seen. Although there isn't any single country that is in the top right corner, meaning that it's fully unbundled and that there's full private sector participation allowed. So obviously there is no ideal case, or there is no case that is very advanced. Possibly the most interesting case study is Uganda, where the distribution segment is run by a private operator, Umeme, under a concession. This has been a really interesting case for us to look into, and we are really lucky to have in this panel later on Mr. Celestino Babungi. I'm very much looking forward to hearing from you, who can tell us more about the Uganda experience with private sector operator in the distribution segment. Also, Ghana has some degree of private participation in the distribution segment. South Africa and Morocco have quite an interesting model of municipal private distribution companies. So there are, overall, I don't want to go into full detail, there are some interesting case studies. Countries do have some degree of openness to private participation, but still it's hard to speak of genuine competition, because even in these countries that do have private sector participation, the private operators tend to have still a monopoly. So let's say South Africa and Morocco, yes, they are private distributors in municipalities, but then every municipality has its own. So it's private, but there is no competition. It is quite similar in Uganda. So Umeme, it is private, but it still has over 95% of the market. So again, there is more room for thinking about new models. I see that Anna is connecting. I had one more slide that is again a snippet from our study. Here, basically what we wanted to do in the study is look into the evidence and say, well, has this worked? The problem of looking into the evidence is that there is a small sample size, so there is not a lot of countries that have experimented with it. And also there is not a lot of data. The availability of data is quite a notorious problem with the African transmission distribution market. But with those premises, there are some very interesting data points that point to a trend, and that is that private operators are outperforming public utilities or their public peers on a whole series of aspects. I only have here two charts. Let's say on the left-hand side, we have a chart on distribution losses in two countries that have both private and public distributors, Morocco and Uganda. Yellow ones are private. There's quite a clear trend that the yellow bar is always lower than the red bar, so the private is always having lower distribution losses. Now, whether that is because they're better at investing in grids or better at preventing electricity thefts, so those non-technical losses, we're not looking into that. We don't have good data on that. But so the trend is quite clear. On the right-hand side, what we have is the share of unpaid bills in total revenue. Here it is several countries. So again, only Umeme is a private operator. We've said that unpaid, well, the non-payment of bills is quite an acute problem in many countries. And so also here we see that the only private operator has a significantly lower share of unpaid bills in their revenue. So they are operating a more sustainable model, a better management model. And so that would be my last slide. As a very brief closing remark, basically we do have quite a good lesson learned in the generation segment, which in Africa, it has managed to attract some degree of private investments in the generation segment, and that has been thanks to a mix of regulatory openness and a mix of private sector participation. So those good lessons those best practices need to be applied also to the grids, at the risk that grids become real bottlenecks. Some countries are already seeing curtailment of renewable energy, so that cannot, Africa cannot afford that. Cannot afford that grids become the bottleneck. So certainly more investment is needed. More thinking is needed about how to scale up private sector participation and think of models. Again, in this study, we did not want to close the discussion and say this model is the best. We wanted to open it, the discussion. I invite you to look into it. You can download it later on. And also to continue talking about what are the models that are more adequate to Africa, to individual countries, with the view of attracting investments in this much needed sector. Thank you very much, Anna. Thank you for everyone. I'm available for questions later on.
Thank you, Yasmina. And again, apologies to come out of the dark here with the webcam. Very interesting to hear these key findings of the report, some of the main causes of underinvestment there, this vicious circle that you highlight, and giving some of the ideas on how to break them more specifically. But what's most interesting is to see that in many countries, there are different experiences as to how private sector participation is already taking place. And in fact, those data points, it's always an issue of data, isn't it? To know and to see actually that private operators are in fact outperforming some of the public actors on a number of indicators in that respect. So I think that's a lot of food for thought, and definitely an invitation to look at the report and looking towards the experience of UMEME as well. I'll turn now towards our next speaker. This segues quite nicely into this part, where we'll ask Ms. Taria Gbadegezin, who's the Managing Director and CEO of ARM Harris Infrastructure Fund Managers, to give us some of her insights, perhaps from the perspective of an Africa-led, Africa-grown private fund that is investing in this African grid infrastructure. You have vast experience in multiple sectors, I understand, Taria, but perhaps some of the ideas of what are the barriers and opportunities that you see in this field. I do have to ask us to maybe stick more towards the time in this respect, and I look forward to your comments. Thank you.
Thank you. Thank you very much for having me. I've really enjoyed the interventions prior to mine, and I think a lot of the speakers have really hit on a lot of the issues. As you mentioned, we are a private equity infrastructure fund that invests in West Africa, and Nigeria is about 60 to 65% of West African GDP. And a lot of the opportunities we look at are in Nigeria, though we have done utility scale generation across West Africa and Nigeria, and currently are keeping our fingers crossed that we're going to be deploying into hybrid models for generation and distribution. And so what I will focus on is really the distribution side. I think Prof sort of spoke very well about transmission and keeping things simple with transmission, but I'll spend a bit more time on the distribution side, especially as tied to sort of hybrid models that we are actually considering and contemplating right now, and really speak from a practical capital allocation standpoint as to how are we trying to make sense of these opportunities. And so I will just preface with what are the sort of conditions that we're looking for when we're looking at participating in grid-linked opportunities or grid opportunities, really at the distribution side. So we're talking about 33 and 11, that world. And so first of all is the legal framework, and just, you know, the idea that a country has actually identified segments and methodologies for private sector to invest. And so we have quite a bit of that happening, where governments are actually taking a step back to identify the ways they would like to partner with the private sector and sort of establishing a framework for how they can support that to happen. That happened in the generation space. So you saw a significant increase in capital going to generation with sort of the world of put call options and things like that. But we're going to see less and less of that as a result of how successful it was. In the distribution space, we've been seeing some pretty interesting sort of legal frameworks around franchising, so private franchise areas, interconnected grids, and some sort of work around tariffs that I'll get into. The second area that's really important for us is cost-reflective tariffs, and I'm going to touch a bit on some of what's happening in that space. The third is around generation, and how do you tie in generation into the distribution model to ensure that that availability is there. And then finally, payment risk, and how do we treat that? Now, I'll speak a little bit about Nigeria because I think that perspective is important, because Nigeria does have an unbundled system where the government controls transmission, but we have 11 privatized distribution companies that are majority owned by the private sector. And so they fall into sort of the model of a sort of a privately operated distribution company. However, it has not been as successful as intended for various reasons, one of which has a primary of which has been the issue of still being impacted by tariffs that are controlled by the government. And so that fear of increasing the tariff has really affected a lot of the distribution companies and their ability to charge a cost-reflective tariff. And there's so much legacy liability as a result that these private distribution companies aren't actually credit-worthy at this time for the level of investments that need to be made. And as a result of that, the government has actually done a lot in recent times to try to think about how do we come to terms with increasing tariffs, given it's such a terrifying thing to do in politics. Second of all, how do we think about creating a framework that additional capital or new parties can support the distribution segment by sort of providing a framework for sub-franchise areas or an ability to almost sub-concession out of that overarching concession framework. And so these are the kind of things that have actually really helped to actually provide a framework for funds like us to actually start looking at the space. So one of the interesting things, just kind of keeping the track on time here. So one of the interesting things that happened in the last couple of years has been that there's a new framework called a service reflective tariff. And so that sounds, it sounds creative, but it's actually been quite interesting because what the government has now allowed from a tariff regulatory standpoint is that the distribution companies are allowed to charge a much higher tariff in as much as they're meeting a service level of over 20 hours per day. That's the first thing. And then the second is that the distribution companies are allowed to arrange bilateral agreements with companies that are willing to pay even more for a 24-hour service level. Now, while some of these, just many of the distribution companies still don't have the capacity to borrow or raise equity, it's actually opened an opportunity for funds to invest in new companies to invest in sub-franchises. And so we're actually looking at sub-franchise opportunities that benefit from these service reflective tariffs and doing so in partnership with these privately managed distribution companies. Now, what's also interesting about that is that in order to provide service, you need energy. And so many of these projects involve the capacity to integrate generation as part of the distribution. So we're seeing this hybridization of generation and distribution at last mile to be able to have enough power to meet the service level to get the higher tariff. And that's also been very interesting because it's not only addressing our tariff considerations, it's addressing the need to have the amount of power to put through the system. Of course, we have to find the customers that are willing to pay, and that does lead to some level of hiving off high quality customers. But even those customers in a country like Nigeria, which is very special, even those customers aren't being served. Many of them are self-generating. And what we're finding is that being able to provide consistent power, high quality, at an acceptable tariff that they're willing to pay, and being able to invest in some of that last mile distribution under a sub-franchise arrangement to ensure that we can deliver it, is actually creating a strong value proposition that people are willing to pay for, therefore allowing the originating distribution company focus on some of the harder areas. There's also the some regulation around interconnected mini grids and franchise areas that is sort of in the more of the retail element, and it ties somewhat to off-grid, but I'd always want to highlight in Nigeria, many people think off-grid is rural electrification, and in many countries it is, but in a country like Nigeria, off-grid is often peri-urban, and sometimes it's even urban, because we have such poor access areas. And so there are also opportunities there, but again, all tied to payment. Now let's talk about payment very quickly. That's a huge issue because as we've seen, the credit quality of distribution companies, whether they're privately run, as the case of Nigeria, or government run, it's not good enough. And so one of the other things we've been looking at is ability to be at front of line of collections, and sort of working more around being able to be sort of at the top of the waterfall. And so that ability to have a legal openness to being kind of at top of the waterfall, which allows us to be, as a private investor or private operator, to be closer to the cash, is of course a game change. If that's not possible, then we start needing sovereign backing. You need all forms of bank guarantees and things like that. And that sort of starts taking us into a world where the sovereign has to provide various forms of guarantees. And right now, sovereigns are fiscally strained. Their ability to provide those type of guarantees is also in question, and whether they will even just renegotiate after some time. That's my timer. So I'll just take a couple more minutes because the issue of being top of the waterfall and being able to escrow or manage cash has actually been very helpful for us, and we think that can be a practical way to deal with payment risk. But the final risk is currency. And if you don't have sort of the guarantees that we had under the generation framework, where you had a tariff that was adjusting and was guaranteed by the sovereign, in this case, we are still including escalations for currency, but the reality is that the tariff is ultimately not in a hard currency. So while it's adjusting, you still have to consider availability and whether you're fully able to pass through those escalations that you've negotiated potentially on a bilateral basis and the like. And so the most sustainable way to finance last mile electricity connectivity is going to be to increase domestic currency in the capital stack. And so that's one area that we're very keen on developing. We do manage a dollar equity fund, but to the extent that companies we invest in can raise more and more local currency for senior debt, so that the dollar equity is actually taking growth and upside, that's really our objective. And so we really encourage countries to sort of develop their pension fund sectors, really encourage DFIs to look at the space of supporting domestic mobilization of local currency to reduce the cost of local currency, as to also be key to addressing this sector, because that kind of question of how do you manage dollar exposure into distribution and last mile always comes back to bite us. And but we can't sort of just leave it for others to solve. We've got to figure out ways to use more domestic capital sources for sustainable finance in this sector. Thank you, Anna.
No, thank you, Tariye. I have to say, this is most interesting to hear this firsthand experience from such a big actor in one of the biggest markets there are in Africa, and to hear your side on some of the conditions that you are looking for when it comes to investment, what should be present, and how some of these innovative frameworks are actually really helping support and leverage the interest, the investment, the resources that are already ready for commitment, and how to really bring those, scale those up to another level. So I find that very interesting as examples to address these different challenges that have already been pointed out by our previous speakers here. And especially the point about rural electrification versus, well, not versus, but let's say being an extension of urban and peri-urban, especially again in a country like Nigeria, that plays a huge role. There are multiple challenges there, but also it is not just a black or white sort of one versus the other story, but they are very much connected. So thank you very much for highlighting that point as well. And when it comes to sort of innovative ideas, I think this brings us towards the segues nicely towards the next speaker, who is Marcelo Castillo Aburto, Head of Business Development at Enel Infrastructure and Networks, who I think can give us some good examples, some experiences that have already taken place in other parts of the world in terms of private sector participation and how these can be replicated for the African case. So really segueing nicely into what this could look like concretely. So Marcelo, please, the floor is yours. Marcelo, I'm afraid we can't hear you.
Now you can hear me.
Loud and clear, perfect, thank you.
Perfect, thank you very much. Thank you to you, Anna, also the Mr. Bigotti, the Mrs. from the fund of Tariff, Mr. Arriaga. Everybody here, is a pleasure for me to be with them in this forum and then with this presentation talking about the future. We, the Enel Group, as you know very well, we are very expert on the distribution sector, but we are not expert in Africa, in the distribution sector. That we are here today to see, to put at your disposal, to be and or maybe construct some, let me say, bridge to collaborate together, to be there in a very few years, working from the regulator, working from the utilities, and working also from the people that needs more or less more quality, for sure, less cost and less tariff in this fantastic continent. Let's go to the first slide, please. I am really excited with this presentation. First of all, we are always looking as a group. Enel, maybe you don't know, but it's the first private distribution operator in the world. But we are not now in Africa. We want to be there just to share all the practice of more than 30 years in privatization and in improvement quality. Then we are very, very strong in the Linux access in all the Brazil. We are the first operator also in Brazil, also in Latin America, but Brazil is very close what we are looking for today in Africa. The people want to connect. The government wants to release how is the tariff and the model. And finally, we reached some agreement because Brazil is always agreement. We make a lot of agreement just to be together with the governors, also with the government local people to buy better services. The resilience is our strength point for us. We have a lot of snow, rains, earthquake. Now we have a volcano in Spain making a lot of, let me say, fire and foam, but we are there making the services possible. Then we are concentrating all the efforts in the customer centricity. People want less tariff, more quality, more digitalization, etc. And we are there trying to solve with the government, always with the government, how to improve it at the best price as possible. Our regulation track record is more than 40 years, and the low-cost technology and innovation is based on us. For the innovation, just finalize here, we have more than 10,000 startups working for us in the last 3 years. And then we choose for the outside people, very intelligent outside of our company, very intelligent in the startup, help us to be more innovative in the solution for the different grid solution in the different market. Next, please. Okay, it's very important. We today, as Enel, we talk with 40 governors. This is very important. 40 governors. One in Brazil, one in the north of Spain, one in Chile, one in Colombia. The governors want to look very affordable energy. They want affordable quality services. They want to be everything very, very, very precise. But we need to talk with them. We need to negotiate. And then it's our experience. 40 national regulation, 74 million customers, 45 tariff reviews in the last 30 years. A lot of discussion about the losses, the technology, the quality, the investment. Also, let me say, a smart grid that you need to introduce in any country. Then we are ready to also apply this all experience in Africa. And we today are very open to discuss with our colleagues here and how we can collaborate together, different models. But after a lot of years, this experience could allow us for sure to enter in Africa with a more sense adaptability with you and my colleagues and with all our clients there. Please, next. Okay, what we do when we get our network? We're going to explain two cases after in Colombia and in Brazil, and that's very close to the reality in Africa, no? For sure, we start to connect the people. We were right there in the north of Brazil. We connect millions of peoples in our concession areas that we have no energy. We made an agreement of 10 years scope with the government, with Luz para Todos, they call, how to connect the people with free subsidy, the subsidy for the government, the subsidy for the customer, the subsidy of the company, and the three columns part, we agree and we allow a million people to enter in the energy access in the north of Brazil. Then we start to look for the losses reduction. The people have no the culture to pay because they are starting to receive energy. But believe me, it's one important issue when we learn in Brazil. When you connect the people, they pay. So they are so grateful with us. When you connect in a consortium with the government, people, and customer, they start to pay because they like the energy, they want the energy, they desire the energy for a lot of years. And when they connect the people, they start to pay. This is very important culture issue. The second, when we are right there, we put all the technologies, low-cost technologies, and smart metering that it all collects and measure what is happening. We introduce the RES integration in these long-distance areas of Africa. There are a lot of photovoltaic points in delivery there. And then we start to the operational efficiencies doing in a consortium with the people there, with the regulators there, and also with the communities there. We start to try to make the best proposal for them. Today, when we invest in a substation in Colombia, for example, we always look for the community involvement. The people are there, recycling the materials, putting the street art, look at what is happening on the energy, which is the hours that you are more expensive and the more low-cost energy. They learn how to make the efficiency in their consumption. And that is the final point. We improve the quality with our technology in the automation, in the high, medium, and low voltage. And finally, all the projects are sustainable. That means that the people are involved with us, the community are with us. We are not a private company. We are concessionary. We have the responsibility given by the government to do a sustainable project in the delivering the energy in a public service company. Next, please. Two cases today because we have only 10 minutes. If we have more time in the next occasion, Anna, we can do more examples. And then we spend 2 times. Colombia, from the last, let me say, almost 30 years, we are operating Bogota. Bogota is a city of 10 million people, 3 million connecting points that is shown here. And in Bogota, there are a lot of issues that we do here about sustainability, about a lot of improvements. And it's very important that the Bogota concession is half of the government, half is the mayor of the city, and the other half is Enel. Very interesting public-private association. Every day, the last almost 30 years, half is the mayor, half is Enel. Fantastic, and it's very efficient. It's very profitable. Reduce the tariff a lot in the last 2 decades, and that is possible. And this is the first example for you, my colleagues. We can do is a partnership 50-50 in that region. We operate the networks, all the mayor and also the Ciudad de Bogota are supporting us a lot to do all the things. Second case, Brazil Goiás. In Brazil, 3 years ago, we acquired a company that was a state-owned company, very inefficient, EBITDA zero, quality like 40 hours there, very strong. A lot of people want the energy, the first issue. A lot of people, we want to be connected. We want the quality. We have the resources, but we don't have the energy. In that case, we fit the private vision and opportunity. We start to operate that company 3 years ago. And now we have reduced the quality from 30 hours to 10 hours. A lot, from 30 to 10. This is a case of Africa for sure. And then we reduce the losses. And when we reduce the cost up to the half, and then we start the community action with sustainability projects. That is the way to do it. This is the model that we are proposing also in Africa to enter and to help the governments to do it better. Next. I am finalizing. The first column is Colombia. This is the beautiful flag of Colombia. Colombia is a nice city for sure. Nice country about coffee, you know very well. Brazil. We have in Brazil Caipirinha. We have also the festival very soon in February there. The carnival is famous, but we have fantastic people here. Fantastic people. Very few people only still the energy. A lot of people support the service, support the energy transition, and support, obviously, good companies doing a very good job. There's Colombia and Brazil. Investment, we improved the investment more than 5% every year. Colombia, a lot of good quality. The city of capital of Colombia is Bogota, have a lot of efficiency introduced in the country, and that was the way. We put more investment. Also in this new privatization in Brazil, in Goiás, we put three times the investment was done in the past, because the tariff were below, obviously, the average. But when you make a plan for 5 years and you discuss with the government how to improve everything in 2 or 3 years, you need to have a plan, propose the investment, and they approve, and you do it. We are making 3 times to the investment was done in the past. The safety first. We love, again, and we worry about the families who are working with us in the networks. We have a very big responsibility with the people, with the mothers, with the people who are operating. Our friends operating the network, and we don't want to make accidents in our concession area. Then a lot of accidents were in the Goiás location, also in Bogota, when we acquired 25 years ago. And with the first issue we go is we need to reduce 90%, 80%, 100% if it's possible in the next 5 years, because we don't want people sad. Let me say, missing one person there, also have an accident there, is really, we suffered like a family. Then the culture of safety is very important for us, and we are going to promote that also in our collaboration there in Africa. The losses, a lot of losses reduction, 60%. But remember, when you connect the people, they start to pay. That's the reality. And finally, the quality of services reduction of 50%. Okay, finalizing for the last slide, Anna. Thank you very much. We have a lot of community projects. We put the energy access in Brazil, #1. We enabled zero target zero in the energy transition proposal to the government agenda. The quality service with the all the people, and finally the local communities also when we construct new substations. Thank you very much to everybody. And we are here, we are very enthusiastic, we have a lot of energy. Thank you, Mr. Bigotti, and we are ready to start in Africa whenever you want. Thank you, Anna.
Thank you, Marcelo, for these very enthusiastic presentation. In fact, it does seem that there are some extremely good best practices, extreme concrete cases that have been implemented in other parts of the world, Latin America, of course, so Colombia, Brazil, that have been complemented in what reflects now by some partnership sustainability models, and how that even actually involves community engagement, which I find a very interesting angle to add, in fact, which creates local ownership as well and sees it as a joint project of what can be done there. So that's another very concrete angle to tackle here. More specifically, how private sector participation also demonstrates successful outputs for customers, so improving the end user side of things, and what in the end that could actually end up meaning for Africa. So thank you very much, Marcelo, for this presentation. That actually brings me to Africa, bringing in a very special Africa perspective here, Mr. Celestino Babungi, who is the CEO of UMEME, who has already been mentioned, Celestino, by our previous speakers. I'm sure you know why. This brings in a very interesting perspective here. UMEME is one of the few private power distribution companies operating in Africa, and the successes that you have shown does beg the question: what are the lessons learned? What has gone really well? We'd love to hear your insights on that. Celestino, please take it away.
Thank you, and it's a pleasure to participate in this, and hearing in from my partners and fellow presenters. Really, it brings it home that there is an opportunity for the private sector to participate in driving electrification in Uganda. The case of UMEME really comes way back in Uganda, when the government liberalized the electricity sector to allow private sector participation in generation and distribution, reforms done in 2000, where the government adopted a single buyer model with a regulator and government retaining policy. So UMEME specifically came in as a private sector player to handle electricity distribution. In terms of history, the company really was formed in 2004, took on the concession, 20-year concession in 2005, and again was run by Actis, which is private sector, and which successfully actually brought the company to the market through an IPO for shared value. And the company was listed in 2012 on the Uganda Securities Exchange and the Nairobi Securities Exchange, and part of the general drive for shared value. What did UMEME bring on board, which previous government did not have? The sector at its point of reform was financially unviable, high energy losses, low connectivity in Uganda, with a lot of subsidies from the government of Uganda, minimal investment in the distribution infrastructure. So UMEME brought on board the capital in terms of know-how, technical capacity, but more importantly, coupled with the financial capital to invest in distribution. The listing on the stock exchange actually provided us a platform to raise private capital to invest in the network. Cumulatively, we have invested over $700 million of private capital. Have we seen any benefits so far? Yes, I think a number of them. First of all, by allowing a private sector to invest in the generation in Uganda, out of our installed capacity of 1,263 megawatts, we've seen the private sector bring in 700 megawatts of capacity, which has carried the country really over the period up to 2019 when the first government generation capacity of 183 megawatts of Isimba was commissioned. We've seen the size of the distribution network more than double. We took on 5,000 transformer zones with around 22,000 kilometers of line. All that has doubled. We are now having 14,000 transformer zones with over 44,000 kilometers of lines. The customer base has, of course, gone up 6 times. We inherited 250,000 customers. We now serve around 1.6 million consumers. Energy losses, which is has been repeated several times, which is a chronic cancer among the distribution utilities, was a challenge. Glad to note that at the time we took over, we were losing 38% of the power we are getting from the transmission company. As of last year, that had reduced to 17.5%. We've knocked off more than 20 percentage points of wastage. On the collection front, and I agree with my colleagues, payment culture was bad. Collecting then at 2005 around 80% of the bills generated. We have innovated, put in technologies, empowered consumers, 100% now rolled out prepayment metering to the domestic customers. And over the last 9 years, our average collection rate is 99%. So people pay their bills as long as the power is available. Coupled with the improvements in reliability of supply and network performance. Overall, the distribution efficiency has moved from 50% to 85%. We've built a lot of capacity. We have the best engineers in town. We know how to do distribution, and we have seen some of our technical staff go on support other utilities in Africa. What's more important is actually we have moved the sector from not being financially viable, where we are relying on government subsidies. In 2005, the turnover was around $90 million. To now, the sector is generating over $460 million of turnover, which has enabled a reduction in subsidies from the government, with the sector being somewhat self-sustaining to absorb all its O&M costs, asset costs, and generation costs with the minimal subsidy from the government. So here is a case for the private sector. Are we yet there? No. If you look in Uganda, 25% of consumers are connected to the grid. The other 26% are using off-grid solutions. Therefore, we still have 1 out of 2 consumers to reach out, potential consumers, to be served with electricity, both on grid or off-grid. Any downsides we've learned over the period? Yes. As a private sector, there are a number of areas of concern, and I think my colleague Linda has covered some of them from IFC. We see the regulatory front needs to be managed because goalposts can be shifted along the way, which could be to the disadvantage of the private player. Policy on tariffs versus desire to invest, that becomes a tight balance. The desire for investments is there. The desire for growth in the networks, providing liability is there. But again, tariffs are set by government. So therefore, that balance sometimes can be challenging. There is need for accelerating access, reliability, and investments. And if you look at Uganda, we estimate we require close to $4.5 billion over the next 10 years to achieve the SDG targets of universal access. But again, if you compare that with Uganda's GDP of 40 billion, you see that that requires 10% of Uganda's GDP to be allocated to driver electrification. So there lies also another challenge. Risk allocation between the private sector and government. Again, there are tools available. I remember in the early years, Umeme benefited from meager instruments and IDA instruments to help to mitigate some of the political risks underlying investments in this sector. Again, we have to look at low-cost technologies to drive access while scaling up. But broadly, I can say in summary, what have I seen? There's opportunity in the private sector to come in to support the governments in their desire to electrify, right? Most of the fallacies around the private sector are around focusing on profitability as the main driver. And most times, sectors, especially governments, and as highlighted by my colleague Marcelo, forget that we bring on board a lot of value, which we create ourselves through efficiencies, through speed of infrastructure deployment, through raising private capital, through accelerating asset deployment to give service to the citizens, other than waiting for governments to come along the way 5 or 10 years upfront. All those needs to be packaged, and I think we need to market ourselves better as private sector, that we can help government. That profit is a result, but more importantly, we are helping governments to achieve their electrification and economic transformation agendas. Thank you.
Thank you, Celestino. Some excellent points here. I think precisely answering the question we were asking. So the benefits that you've seen from the Umeme case shows that there has been a vast increase in installed capacity, sizing of the distribution networks that have doubled, a six-fold increase in the customer base. So going back to that point about when you connect, they actually, the customer base grows. So a huge capacity to increase the turnover here. And as well, noting down some of the next steps that you expect where some support might be necessary. So on the policy and the tariff side, very much. Accelerating access to reliable finance, of course, reaching back to our IFC colleagues and to Taria's comments. It's a good thing that some of these tools are made available. Maybe more some innovative thinking can take place here to really leverage and step up what is necessary, both on the generation capacity side, of course, but on grids most certainly. And I sort of remember from your point of view now that the most important part is the private sector really stands ready to help government here and to support what it is that is necessary from their side to really kind of come to across the aisle suggestion of solutions. So thank you so much for this most interesting perspective. I have to switch now to your neighboring country, in fact, to Kenya, where I would like to ask Daniel Kipto, who's the Director General of the Energy and Petroleum Regulatory Authority, to give us another African perspective here. Kenya is, of course, a market to watch. Many things have been taking place within the country, within the power sector there as well. So it would be very interesting to see from you where you think some of the successes are and what you expect for the near future when it comes to grids in Kenya. Please, Daniel, the floor is yours.
Thank you, and good morning, good afternoon, everyone, from wherever you are. I'm Daniel Kipto. I'm the Director General of the Energy and Petroleum Regulatory Authority. I'll just take you through a few slides on the opportunities for private sector investment in many grids in this country. I think a good place to start is how this sector is structured in Kenya. We do have a Ministry of Energy that gives policy guidance to the entire sector. We have a sector that is vertically integrated but unbundled. We do have generation, transmission, distribution, and retail. As you can see there in that diagram, we are the regulator. We regulate the entire value chain. We do have in generation KenGen, which is an entity majority owned by the government, and we also have IPPs playing in generation, as well with a geothermal development company. And then we also have imports coming in from our neighboring countries as well. And on the transmission side, we have a fully owned state utility, the Kenya Transmission Company, and we also have a distribution utility. This is the Kenya Power and Lighting Company. We also have a private discos as well, playing in the space of mini grids. And we now have a retail, which is also run by the utility KPLC. Next slide, please. For us as a regulator, we are mandated in the law, this is the Energy Act 2019, for the technical and economic regulation of the electricity, renewable energy, downstream coal, coal-based methane, and petroleum subsectors of the country. We draw a mandate from the law, and this is the Energy Act 2019, and specifically Section 10. We regulate the entire value chain in the energy sector, from generation, importation, transmission, exploitation, distribution, supply, and the use of electrical energy, the exception of nuclear, which is regulated under a different regime. We also regulate the entire value chain in the petroleum sector. This is upstream, midstream, and downstream. We review and coordinate all permits in relation to upstream petroleum development. Next slide, please. We're also mandated to keep information and statistics both for energy and petroleum, to maintain upstream petroleum data. We also deal with matters of cost recovery. This is in relation to upstream petroleum. We also have a mandate of dealing with competition and trade practices in the energy and petroleum sectors. We have a big mandate in terms of balancing interests of investors, consumers, to ensure that we do strike the right balance. And we also provide the information statistics and give advice to the Cabinet Secretary in charge of energy and also the Cabinet Secretary in charge of petroleum. Next slide, please. In terms of power planning, we do have a rolling 20-year least cost power development plan, which we actually utilize to plan for our generation capacity and also plan for our infrastructure in the medium term and the long term. In terms of generation, we also have a generation plan, and we also look at our tariff progression in the short and medium term to ensure that we do have security of supply. What you see on the right there is really our progression in terms of our mix in our system between the year 2020 and going forward to the year 2040. Next slide, please. In terms of installed capacity and the landscape in Kenya, we do have today an installed capacity of 2,148 megawatts. We have 38 PPAs signed up for various technologies. As you can see there, we have 8 in hydropower, we have 11 geothermal based, 10 thermals, 4 wind power PPAs, 3 solar PVs, 1 biogas, and we also have a PPA for energy exchange with our neighboring country. What is also important to note is we do have 34.67 megawatts of off-grid stations. And these are managed by the majority-owned utilities, 2 utilities by government, that is Kenya Power and Lighting and the Renewable Energy Corporation as well. Next slide. In terms of how this PPAs, the 38 PPAs are spread across public and private sector, we do have KenGen, which is a public sector utility holding 15 PPAs. We have private sector through IPPs holding 21 PPAs with a cumulative capacity of 1,092 megawatts. We have 1 PPA by the Public Utility Renewable Energy Corporation, which is a solar technology PPA of 50 megawatts. And we have 1 energy exchange agreement for imports as well. Next slide, please. In terms of where we are as a country going forward, we are now looking to transition from the feed-in tariff policy, which is an unsolicited form of procurement for power in the country, and transition to renewable energy auctions. I think one of the big issues here is an issue of risk allocation between the investor and the government when it comes to the 2 systems of procurement. When you look at FIT, really a lot of the risk sits with the government, and when you go to auctions, a lot of the investors and private sector will be able to sit with a bit of that risk. In terms of also cost, from a standpoint of price discovery, when we go to auctions, there will be an opportunity for more price discovery, and also ensuring that in terms of certainty, and we don't have a lag between when the project is procured and when it is implemented. And I think really in terms of FIT, this is one of the areas that the government is looking to transition, particularly the intermittence away from FIT into the auctions. Next slide, please. In terms of auctions as well, I think one of the big areas that we're looking at in terms of innovation, and how do we then promote innovation when it comes to auctions, because auctions sometimes really will be looking at technologies that are more mature, more established. There's a lot of conversations about, for instance, hydrogen, and I think there needs to be a bit more conversation before we as a country start to have a conversation on some of these new technologies. I've already spoken to the matter of price discovery and how auctions are more preferred from where we sit. And in terms of longer term view and adaptability, each auction is able to be fashioned based on the realities on the time, on the day, and also based on the last procurement that was conducted. And I think auctions will be able to be more agile and is very adaptive, as opposed to a feed-in tariff policy really that is not as agile. Next slide. In terms of the PPP environment in Kenya, there has been a review of the Ppp Act in Kenya. This review is almost complete. It is sitting with Parliament. What the government is looking to do is to make the PP process much simpler and much quicker, so that then we're able then to meet private sector requirements in terms of speed, and how we then identify the project, take it through the select gate process and select the project, screen it, go through the process of structuring, which will also involve risk allocation, government being able to bring on board the transaction advisors to be able to move and proceed with the PPPs, go through the procurement process, execute the PPP contract, and get into implementation. I think really the message here to private sector is that we are looking to see how we can be able to match the requests that we keep getting in terms of the speed through which we actually take this process through the screening process and the projects through the screening process, and ensure that we at the first make sure that we do the right transaction for the country, but more importantly also move with speed so that then the projects get executed on time. Next slide. I think really what this slide talks to is really how the journey that we are walking, starting from a vertically integrated sector, and the journey that we walked in terms of bundling from 1997 to where we are today. And where we started from is where public sector utilities retained all the entire responsibility of financing, constructing, operating, and maintaining assets, and also keeping the associated risk, and walking through a journey where we are now looking to go to full privatization of investment, particularly in transmission, having PPPs in transmission, and having private sector play in both transmission and generation, so that then government can focus on more on its core mandate. The next slide, please. In terms of one of our mandates as a regulator, and really, and this talks to the topic of discussion today, which is increasing or attracting private sector investment in mini grids and also in generation in Africa. I think one of the big issues that we deal with as a regulator as part of our mandate and mandated in the law is pricing and tariffs. When we look at tariffs and we are looking to review tariffs, we look at the economic and financial viability of the project, the technical feasibility, what are the legal implications, what are the HSE implications as well, and also look at issues of competition and completion risk as well. Next slide. I will not speak much to this slide. This is just how the process in terms of our internal review process on how we go through the tariff design and the tariff setting process. The first one is looking at demand forecasting. We then look at generation planning. We determine what the revenue requirements are. We look at what the marginal costs are. We then determine the total revenue requirements. We then compute the initial tariff and then run a sensitivity. We engage our stakeholders and eventually take a decision as a regulator on what the tariff should be for a particular utility. Next slide. In terms of our tariff review process, we do have a 3-year tariff control period. And one of the policy objectives, particularly for retail tariff, which is useful for this conversation on many grids and off grids, is we do seek to achieve an economic policy objective to ensure that we have efficient resource allocation within the economy of consumers, that we only pay for costs that prudently incurred. We also have a financial policy objective, so then we ensure that our utilities are financially viable in the medium and the long term, and also have a social policy objective, so then we reallocate costs across consumers with a view to safeguarding certain vulnerable or special consumer categories as well. Next slide. I think in terms of looking at a tariff, we actually look at, I think first is to start from a standpoint that we are of the view that we look at cost-reflective tariffs. We want as much as possible to ensure that our tariffs are cost-reflective. And as we compute our tariffs, we need to ensure that they are market returns for prudent investment. And these are based on our regulated asset base and your rate of return. We also look at prudent levels of O&M expenses. We also look at depreciation, applicable taxes as we compute your revenue requirements. Next slide.
Daniel, I'm going to have to ask you to slowly start wrapping up your intervention.
Yes. I think I'll skip that slide. Just go really to the slides on the discussion of the day. And I will request if you could just keep going, and I will request that you actually go to slide number 21, and I'll just speak to that. I think really in conclusion, there is a lot of opportunity and space to play in Kenya, particularly investment in generation. We are looking at investment not only in grid-tied generation, but also off-grid. We have had a good story in Kenya. We're able to increase our access from 23% in 2012, 2013 to 75% as we speak today. And I think a lot of the 25% that is left will be served through off-grids and mini-grids, and this is where there's an opportunity for private sector to play. We are committed to provide an enabling environment for private sector to be able to play in the space of generation, particularly off-grids and mini-grids. There's also an opportunity when it comes to investment in transmission lines through PPPs. And I think from a regulatory standpoint, from what I've just taken you through, and the team is really around incentives and cost recovery for tariffs, also incentives in terms of investment to private sector, and also the conducive laws that have been put in place by the Kenyan government to be able to enable investment. I think in closing, for us as a regulator, we are here to ensure that we do have an enabling environment through regulations and also through oversight and promotion, so then we have a robust energy sector in the country going forward. I think I'll stop there for now, Anna, and hand it over back to you.
Thank you very much, Daniel. A very useful overview of the evolutions that have happened in the Kenyan space, especially from a regulatory point of view, the evolution in the landscape across multiple technologies, but also this transition from feed-in tariffs to auctions that are about to take place, and that really will, the message is loud and clear about the further space that there is for private sector participation within the sector. So thank you so much for your words here. And as we've come to conclude, to sort of towards the end of our session here and our time today, I'd like to turn to Amel Shadli, who's the Vice President of Strategy and Digital Energy for Middle East and Africa, to give some of her closing remarks, maybe sharing some views of where they see the grid sector in Africa evolving and their vast participation in Grids for Africa. Please.
Thank you very much, Anna. It's a real pleasure and my honor to be with you and to give the final remarks. As we've seen, in fact, in the study of PwC, the cost of the technical loss in Sub-Sahara represents 2 to 4% of the African GDP. So just imagine what we can do with this money for the development of the continent. The improvement of the grid and the acceleration of the digital transformation of the infrastructure in Africa will for sure boost the economic and the social growth for the continent. As a Schneider, we are committed to power 1 million people with green and renewable energy. For that, we have a very comprehensive portfolio that could be achieving our target, including our digital products and software and advisors called EcoStructure. That is allowing, in fact, to integrate the renewable resources in the grid. Concerning Grids for Africa, this excellent initiative, and I really want to thank Rest for Africa for this initiative that we believe a lot on, has two main goals. The first one is to bring the awareness about the importance and the challenges of the grids infrastructure in Africa. The second importance, or the second goal of this initiative, is also to bring together the private and the public sector in order to improve their collaboration and in order to improve the infrastructure of the grid in Africa. In 2021, Grids for Africa had an amazing program, and we see with the webinar of today how rich are the panelists and the study that we had. 2022 will have even more rich program. So in Q1, Grids for Africa will be focusing on the financing capacity of the grids in Africa. And we see in one of the presentation that just for the power generation in Africa, we will be needing an investment of $345 billion by 2040. So you can understand the importance of such initiative where we will be discussing with the financial investors how to finance the needs in terms of investment to improve the grids of Africa. In Q2, Grids4Africa will be focusing in Morocco and will be focusing on the private participation of the distribution grids of Moroccan municipalities. Then in Q3, Grids4Africa will be working for the presentation at the G20 about resilient, smart, and sustainable cities. And finally, we will be having in Q4 a focus on South African case study, and that will be presented during an online event. So this is in very nutshell the activities that will be handled in 2022. On the name of Schneider, I really want to reaffirm the support that we will be having for Grids4Africa. It's just an amazing initiative, and I will request our participants to do the same because we have a very honorable goal to bring the energy and the clean energy for African continent and to help the 600 million people that don't have access to energy. Thank you for that.
Thank you so much. Anna, let me just say a few words and then thank you, first of all, for the excellent coordination. First of all, I appreciate the quality of the panel, the insight they gave. I am still an electrical engineer. When I was young, I was doing transmission. So for me, it really goes back to my professional career. There were up to 340 attendants, which is amazing. This shows that the choice of Grids4Africa private sector participation is really the correct one. We really will be able to send you a link, or anyhow from our website, you can download the PDF presentation with the permission of the author and also the paper. I remind you, there is no password and no registration. Our website is open to anybody who wants to share our innovation. Also, we will also follow up with our speakers for a group dedicated to support us in shaping the new program for Grids4Africa 2022-2023. But thank you also, Amel, for having already Schneider on board. Finally, let me thank you, all of you, for the patience, the team of Antonio who prepared this one, Yasmin, of course, and Anna Asia for leading us to this event. I think it was a great event. I'm really proud and happy, and more to come, because Grids4Africa is going to be a shining logo among the other ones. Arrivederci, everybody. Ciao, ciao. Ciao, Anna. Chiudiamo, no?